Sir, very few PMSs in India might be using technology the way Sameeksha Capital uses. I got to learn about your proprietary software called RAW. I also got to learn about the fact that all your earnings and financial models for all the companies under coverage are updated automatically after every quarterly earnings season. Could you elaborate a little bit more on this as to how are you using technology to research and portfolio management?
So, RAW, you mentioned RAW, so it stands for Research Automation Works. So essentially, we want to automate whatever steps can be automated using technology. Because, we do a lot of repetitive work. There's a quarterly result every quarter, for example. So we have identified, and we are continuously identifying how can we use software and technology to basically make our research more efficient, time efficient, and also take out the repetitive and mechanical aspects of work. Obviously, of late there is a whole talk about Gen AI. I would say we are still in the early stages of deploying Gen AI, but we have had some success in using Gen AI to essentially categorize the notes that we take into relevant subfields. In fact, that brings me to an interesting point that everything we do, we document everything we do. We talk to a company, we take detailed notes. And by categorizing these notes, we should be able to look at the past, history of what company had said different point in time about different topics. And I think so when we are re-evaluating a company that we had looked at before, it helps us get up to speed relatively quickly. The detailed, valuation framework essentially means trying to apply a cash flow or a cash flow equivalent method to valuing a company. If it's a financial company like a bank, we might use excess ROE. If it's an insurance company, we might use the embedded valuation and concept and so on. But ultimately, we want to get to the intrinsic value of the company based on reasonable long-term assumptions. So making reasonable long-term assumptions is very important. And for that, we have created a macro model for India. What is the India's economic growth potential over next 20, 30 years? Within the context of that, we create an industry model that XYZ industry, is today this big. In a country that has developed before India, let's say China, that industry is this much. As India, sees that growth in GDP per capita, this industry can go from here to there. So that creates that, roadmap for growth for the industry. And then we tie the company into that. This company has this kind of a potential, this kind of capability. So in this industry, they can gain market share, they can maybe maintain market share. And sort of that's how the growth assumptions are derived. And then we go into the profitability and return on capital. What is the genuine potential for this company to deliver on that? And I think all that together, comes into a final sort of intrinsic value that we get for this given business. And then we apply our criteria, whether or not it is worth investing based on that. I think technology kind of, runs deeply into everything we do, whether it's research or whether it's operations. And we will keep trying to find a way to use technology to make our work more efficient and stay relevant.